Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about housing starts, inventory, and mortgage rates. I want to thank our sponsor, Rocket Close, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. It's Friday morning, just got off of CNBC interview, and fortuitous timing with the topic at hand. Builders' confidence is 4 points away from the COVID-19 lows. Housing permits are still at recessionary levels and falling lower. But the existing home sales market, like I talked about on CNBC, has had 15 straight weeks of positive year-over-year data. So the builders and the new home sales market has always had an advantage against the existing home sales market for the past few years. So the question is, has the turn tide for the existing home sales market versus the new home sales market?
So this is so interesting because anytime you're talking about something, you want to separate it out. If it's purchase apps, if it's whatever, home sales, if it's whatever, you're like, there's new home sales and there's existing home sales. And these two things do not cross. Tell us why the new home sales market is so different.
So this is actually a very interesting story. In the previous decade, when I started writing about housing economics, my baseline case in 2010 was that we were going to have the weakest housing recovery ever, and new home sales in particular. Housing was more affordable, rates were low, there was more inventory, but the builders were at a disadvantage because there was a lot more active inventory that was cheaper. The builders' corporate profit margins weren't that good. So it ended up being the weakest housing cycle for new home sales, weakest housing construction cycle ever. Because remember, sales and construction move together, right? And I think a lot of people had just had bigger expectations. But here it comes years 2020 to 2024, household formation, corporate balance sheets. Everything is in a much better shot. However, builders had a very unique advantage. It reversed, right? And the new home sales market was never exploding or booming like it did during the housing bubble years. So here comes 2022. New home sales are falling, housing permits are falling, cancellation rates, and then November 9th came. And why? November 9th is our infamous day. And at that point, the forward-looking data started to get better. However, it was more beneficial to the builders because advantage, disadvantage. Inventory was still low, but they can pay down rates. So we have this unbelievable huge gap. Traditionally, like new home sales, like 10 to 13% of sales, it rose up to about like 28% or 33, around there, a very high level in the 21st century, because they could offer 6% plus mortgage rates. They had the balance sheets of big publicly traded companies. So their sales levels is at 2019 levels, even today. Where the existing home sales market is still at what I would always say all-time lows when you adjust it to the workforce back in 2008 levels. So here it is, this unbelievable gap where it was the reverse. So for a while there, the builders are just completely outperforming because their total units of completed sales were very low. They were able to pay down rates, but as inventory started to increase for them, as completed units started to increase, and then rates stayed elevated, it's starting to cost more to do the pay downs. And now they're at such high levels of sales versus the existing. Advantage, disadvantage, the existing home sales market, because it's working from the lowest levels ever, has had 15 straight weeks of positive year-over-year growth in the purchase application. And affordability, inventory is rising. There's more choices. Price growth is slowing down. They don't sell homes as a commodity. It's a buyer-seller's profile. For the builders, there's margin pressure, there's a supply increase, especially in the South. So much of their building over the past few years have been in the South. Totally different marketplace. Again, if the 10-year yield goes lower, mortgage rates get down to 6%, a lot of issues are solved for the builders and existing home sales can grow. We just don't have that monetary policy yet. So that was my theme with on the CNBC interview, is that a lot of people say, well, lumber prices and labor costs. I was like, homies, man, 10-year yield goes down to 380. You get normal spreads. All this stuff is let go, right? That's just how the world works. The 10-year yield rules all. So in this context, the existing home sales market has the ability to slightly outperform the new home sales market this year. And so far, we've seen that in the data lines early on.
It also explains why we can't build our way out of the housing shortage or housing crisis or affordability crisis, which you wrote a very good article about, I don't know, a couple years ago now.
June 21st or June in 2021, when everyone was like, oh, we're going to have a construction boom. And I go, oh my God, you kids are so cute. Wait till rates go up and it's not going to happen. And then oddly enough, next year rates went up. And literally, if anybody looked at the housing permits data, Walking Dead, nothing. COVID-19 recession levels. But you always hear this is that we're going to have a construction boom. No, you're not. You people do not understand how businesses are run in America, right? So it's a
Right.
lot of journalists and, progressives who believe in socialism and conservatives who say that we need more. Guys, it's a business. They
Yeah.
are here to make money. This is why we coined the phrase, they are not the March of Dimes, right? So when rates get elevated, right, luckily the big publicly traded builders have enough corporate profit margins to actually pay down rates. Imagine if that didn't happen. Where's new home sales? We're at less construction. We're at less new home sales. So we have an advantage in that, but it just shows that there's a natural equilibrium between supply and demand, and the builders sell homes as a commodity. And that's how it works. So it's not shocking that if you look at the permits data, not gone anywhere. Housing starts data, not gone anywhere. New home sales, when rates go lower, sales pick up. When rates go higher, sales go down. Hasn't gone anywhere. There was never a construction boom, right? It was
Right.
all a fabricated lie into thinking that people just put their heads down and go, oh, we're just going to build so much supply and there's going to be millions of homes. That's not how the builders have ever operated since the 1960s. This is why I always like to show those charts going back to the 60s. Hey, listen, well, rates went up. Oh my God, the construction falls. Oh my God, rates go down, construction picks up. So if you want more housing construction, you need lower rates. And if the last 2 years, 2.5 years have not explained this to you, homie, there is nothing I could help you out now because it is clear as crystal.
Okay, so that's true. And we know that's the biggest factor, but it doesn't help builder confidence when they're looking at higher lumber prices, when tariffs are very uncertain what's going to happen. I mean, that doesn't help throwing that into this environment.
Sarah, what was lumber prices during COVID?
I know they were 1,500 per board feet
Yes,
or
they
whatever
were.
versus.
And how is new home sales doing back then? It was doing good. Why? Builders had we're working with 3% rates. Now, we can't get to 3, 4, 5 with Fed policy right now. Remember, 65 to 75% of where the 10-year yield and 30-year rates, the slow dance. Do you like my outfit today for
I
CNBC on
do.
Friday?
It's
I
very
felt bad for the
70s.
guy. I should have dressed down a little bit, but
Oh, on
looked like I
CNBC.
just came back from a club, but which I never do. In any case, back then, mortgage rates were lower, demand was higher, lumber prices did not matter. So why does President Trump want lower rates? Bassett and everyone knows if the 10-year yield goes lower and they do have
Right.
tariffs, right? And if lumber prices do go up, they saw this. They saw all the inflation. Oh my God, we couldn't even get garage doors into new homes back
I
then.
know.
We had all this drama back then, and then we couldn't finish homes, and didn't matter. People were like, "Oh, mortgage rates are lower." So the whole premise of that CNBC interview 6 weeks ago was President Trump wants lower rates to fight tariffs because he saw it work. So yes, lumber prices were a lot higher, but rates were low. So in the realistic world, we can't get to 3, 4, or 5 anytime soon unless the labor market breaks or something. But you can get towards 6%. 10-year yield goes down, 6% mortgage rate, spreads get better. Guess what happened in the last 2 years? The builder's confidence picks up and permits start to pick up a little. So we're in that environment. You have to deal with the hand that you possibly could deal with in this game. And as I have pounded my fist down for the last 2 years on CNBC, you just need 6% mortgage rates. You don't need 3, 4. If we needed 3, 4, 5s, we're all having a different conversation right now.
Yeah.
But monetary policy is not restrictive or was not restricted enough to keep the expansion from going into recession. but it is and has had an impact in the housing market since 2022. So we are sitting here with 2.5 years worth of data. It ain't happening. But you have a solution, right? So, one of the things that we've talked about, how do you go into a trade war? Uh, it probably would have been better for Trump to have had the tax cuts. We're talking on Friday morning. I don't even know if the thing passed or not. They were doing a vote. There were a few Republicans that weren't going to pass for Trump's tax cuts or the budget, but if he would have had this, and then they would have deregulated some of the rules on banks holding a little bit more treasuries, the SLRs. Bissett wanted to get that done. They haven't done that. They would have maybe had a little bit of better backdrop for housing, but we're still here with elevated rates near 7%. The 10-year yield is, I think, 4.43 when I left. So the 10-year yield looks right to me still, but again, I understand why Bissett and Trump and everyone wanted lower mortgage. Could you imagine if rates were at like 5.5 and 6.25, and we're buying homes and housing permits are going and construction is going, and that's what a powerful country does in an expansion. People buy homes, they have sex, they have kids, household formations, we build homes, everything. You could run with that story in
Right.
2025. So we just didn't get there. But for the existing home sales market, it was a benefit that the 10-year yield fell this year.
Let's talk about mortgage spreads, right? Because, okay, in this environment where we need all the help we can get, what are we getting right now from mortgage spreads?
Okay, so mortgage spreads, right? And one of the things I go when I do the nerd tour, I always a hand of anybody who knows what mortgage spreads are. It's like 3 people, right? So how do we just talk about mortgage rates? Slow dance, 10-year yield, 30-year mortgage rates, been slow dancing. But sometimes we want an intimate slow dance. We want the 1970s Soul Train intimate slow dance. That's mortgage spreads being compressed and being back to normal, 1.6 to 1.8.
Right.
That's where it is. If we had normal mortgage spreads, mortgage rates are at 6% today. But when rates go up, when there's market volatility, spreads get bad. After the Silicon Valley banking crisis, mortgage spreads got to 3.10%. So not a good, very bad slow dance. The guy looked at another girl. The lady doesn't want to dance with her. That's not good. But the spreads have been getting better. We're halfway back to normal. So that's a positive. Like mortgage rates could be near 8% today if we had 2023 spreads. So if we did not have any market drama this year, the spreads would have behaved very well all year long. When the stock market was acting crazy and bad and the bond market was crazy, spreads got bad again. It cost us about 20 to 25 basis points at the peak. But now, spreads are getting a little bit better. So if the market's calm and the Fed continues its rate cut, the spread should improve. If the 10-year yield goes down, mortgage rates go lower. Mortgage rates going lower with better spreads, there's your 6%, sub 6% mortgage market. Right? We need about 1% more of rate cuts to get that low 6 level a little bit more attainable. And then if spreads get better, you get that sub 6%. Everyone's doing more business. We're buying more homes. Oh my God, we could have housing permits rise again. Could you imagine that? We've always had housing permits rise in expansion. This isn't it, because the Federal Reserve's policy is too restrictive for housing. So it was encouraging to see the spreads this year improve. Of course, the market drama took that away, but now we're looking at it, and it's gotten better the last few days. So that's a positive. So we'll see what happens in the future. But again, I've always been a labor over inflation guy. If you want sub 6% mortgage rates, you need the labor market break. But there is a pathway to get there that doesn't need the labor market break. So it should be another interesting last 8 months of the year to see how Trump deals with Jerome Powell. Does he start to implement the shadow Fed presidency where hypothetical Warsh comes in and says, we're cutting rates, don't listen to Powell. America's been too restrictive on policy. We need housing back. We'll see if that ever occurs, but at least now the spreads have gotten a little bit better. So we're still not back to normal, but we're halfway there.
That's good. That's good. Okay, let's talk about inventory a little bit. You're going to be doing the tracker here tonight. That's what you do on Friday nights because that's when you get the data. Tell us a little bit about inventory.
I'm going to wear this outfit and do the tracker tonight because then I feel like I'm doing so. In any case, positive story for 2024 and 2025 for the existing home sales market. Inventory is growing, right? The whole mortgage rate lockdown inventory can grow with rates high. Didn't happen. Positive. Price growth slowing down, positive. Now, why is it bad for the builders? Builders are here to make money, right? So they have certain margins they have to keep going. So the active completed units for sale is 120, around 120,000. Historically, going back to the 1960s, that's kind of the peak, right? In 2008, it's funny. We always joke about these people who say, "Oh my God, there's more homes that are being built, millions of homes." Homie, it never even got to 200,000 during the housing bubble crash in 2008. Why? None of y'all read, because you would never say such a stupid statement. And by the way, if anybody's listening to the birth date rate, I'm getting birth death rate models on inventory skyrocketing. Listen, these are professional grifters, people. These are the anti-central bank. These are your loser friends with loser YouTube channels and loser X accounts and Instagrams. Do not listen to them. We just had supposedly the 10-year period where the silver tsunami was about to take off from 2015 to 2025, because the first baby boomer hit 62 in 2008. So they were going to downsize. So we went 15 or 10 years waiting for the 26 to 32 million active inventory that was supposed to hit the market. We literally got to 240,000 in March of 2022. 26 to 32 million to 240,000. These people are trash. They're garbage. Not even the Russians and the Chinese and Iranians do this, but they still do it, right? We had a period where we had more elderly people die during COVID and inventory broke to all-time lows, right? So
Yeah.
no, it's not a coherent model. New listings data is getting back to normal, positive. Inventory is trying to get back to normal, positive. But the builders' completed units of sale is basically at a level to where housing is basically peaked before. Again, profit margins, they're here to make money. So they're sitting on like one of the highest levels of homes that haven't even started construction. It's not a lot of homes, about 100,000 homes, but they're sitting back and going, we're not going to be issuing permits here. So inventory growing positive for the existing home sales market, another existing home sales positive outcome. But for the builders, they're like, oh man, on top of elevated rates, we have tariffs. I don't know what's going on, So builders, the existing home sales market for the first time this year on the inventory side has a better storyline than the new home sales market because they sell homes as a commodity.
And of course, inventory is so specifically local. So you and I talked to somebody at the KW, the Keller Williams event. He was telling us he's in New Jersey in sort of a bedroom community to New York. And literally, it's like they're in 2021. They cannot, there's very few houses to sell. They go for hundreds of thousands over asking. They can be in terrible shape. It doesn't matter. People buy anything. And I was just like, wow, those markets are, simultaneous to something maybe in Florida where it's really hard to sell a condo.
The Northeast inventory story is still savagely unhealthy. The West is picking up a little bit more, which is getting better for them. Oddly enough, the healthier inventory markets are the South, right? Because prices escalating out of control. It's not good for anyone, right? It's not good for anyone, future business or current, right? You just kill affordability. So the South to me is more of a healthy. Florida has specific issues with insurance and the condo markets, but in general, the West and the South is much healthier than the Northeast. Is just no. There's still some of these areas are still like 40, 60, 70, 80% below pre-COVID levels. Not a very good housing market in that sense, because why? Price inflation is allowed to still stay at very unhealthy levels on a year-over-year basis. You don't want that. You want price growth cooling down out there. Because remember, we can't look at housing as, okay, by the end of December, that's it. Housing is going to be here for decades, and decades. And whenever prices escalate out of control, you need a period of time where price growth cools down. We saw that, in the 1940s, prices escalated. It was the hottest home price growth period. Then they cooled down. In the 70s, price growth was very hot. In the late 70s, they cooled down. Housing bubble crash was very unique. You had home prices escalate out of control, but you didn't have inflation. That was a credit boom, credit bust. Credit bust, foreclosure, short sales, not a good thing. That was an unhealthy housing market on that sense. But here, you just had too many people chasing too few homes. So the Northeast is not a good, healthy housing market with inventory that low. Very, 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 very hard, because considering that this is the fourth calendar year of the lowest home sales there, rates have stayed elevated. We can't get much traction going. We built a lot of homes in the South.
Yep.
over the last few years. We did not build that same amount in the North, and there's consequences for that. So this is unfortunately one of the unhealthy stories has been the Northeast. I look at housing differently than other people because people go, "Oh, look at inventory is not growing." That's not a good thing. It's not a good thing. Supply is a function of demand. Supply is a function of keeping prices stable. You want supply rising. 2023 was bad. Like 2023, new listings
Yep.
data went to all-time lows. Home sales didn't go anywhere. You didn't really have any mortgage growth year over year. Home prices were way too strong for what the demand curve was. But 2024 and 25, it's a process. It's a healing process. But again, separate existing and new home sales, two different marketplaces. Existing home sales in general, constant terms for the nation, positive data lines. For the new home sales market, profits matter. So more troubling in that market. And it makes sense for the builder's confidence index. Remember, when we talk about the builder's confidence index, it's smaller builders. It's not the publicly traded builders that have so much cash on their balance sheets and have the ability to pay down rates when they need to sell homes.
So nature is healing, housing is healing. We just need a little bit lower rates. We need some of these headline things to get resolved, maybe get some trade deals resolved so that we have less volatility.
It is. And to think about that with all the crazy confidence data that's terrible out there and all these headlines and everything, and stock market was in a bear market, purchase application data had positive year over year growth the
Yep.
entire time.
The
10-year
resilient.
yield went lower. 10-year yield went lower this year at the start of the year. It didn't do that last year. 10-year yield rules all. That's what I did on the CNBC. Everyone's like, Carl continues, well, what about labor? What about construction? I'm telling you, man, 10-year yield goes down. It's amazing. The builders sell new homes and they build homes. The labor shortage just isn't talked about, in that sense. Go back to 2013. They've kind of said the same thing, but in this context, it's really demand. Right? Somehow in America, when demand is there, we get stuff going, we build stuff, we need stuff. It gets there in that light.
Logan, thank you so much for being on today in your in the suit jacket that matches a couch that we had in our in the lobby of our last office. Do you remember that?
Oh yeah. Everybody said that. Look, that's like Logan's outfit. So I was like, if I had it on, I would have taken photos. It would have been, one of those catalog photos that used to. Oh, thank God, none of my old modeling photos are ever going to go public.
Oh my
That was
gosh.
that was a terrible time. I used to have blonde hair, sideburns. I was always tan. I had
Listen,
to
if
do
someone wants to go and find
no.
those, that would
You
be
can't
very
find them.
valuable.
They're locked away. There are a few out there, but I had to do a Levi's commercial, audition for a Levi's commercial. Mind me with my shirt off and my shorts showing, but the director said, "Oh, let's do it Austin Power style." And it's like right on the spot because that's just when Austin Powers movie came out and there was no prep or anything. So I had to do these lame like commercials back then in the 90s where, these people look like they're starving to death in
I would
clothes. Like one of those,
pay so much money to
it's
see
never going to
this.
be found. It's never going to be found. But literally I had to do the I had to do the commercial in Austin Power store. Yeah, baby. Yeah. And that I was like, what am I doing? This is not for me. Right. This is not the Lord did not put me on this. The Lord did put me to do housing economics and take on American bears. That's what they've done. Take on the
That was
Russians,
the
the
moment
Chinese.
that cattle, it became clear to you. You're like,
No,
no, this is not
you know what it did. This was even a worse story. Um, they were trying to teach me to do the catwalk. God, I'm embarrassed to even say this. And I wasn't doing it right. And I had this 10-year-old girl just yelling at me about how terrible I am to do the cat. And that was it. After that, I said, man, I'm an athlete. I play ball. I'm not getting yelled at by some girl about not doing this cat. I walked out. That was it for me. I said that was it. I had a Tilly's contract for 1 year doing all 4 seasons. And of course I break my nose in a lifting accident. The universal powers were telling me, no, get away from this. This is not your thing. Your future is dealing with the American bears and the Russians and the Chinese and Iranians who put
so.
disinformation. And this is where I am today. I'm exactly where I should be. And
Yes.
I'm blessed beyond belief.
Their loss, our gain. Happy to have you covering the economic beat for us as opposed to doing that catwalk. But we appreciate it, Logan. Thank you so much.